Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be taking a quick look across markets. I'm going to be giving you a bit of an update as to what's been going on this week, and we're going to be talking again about the big events that are coming up for the rest of the week and how they could affect markets. So the most interesting sort of asset class to me so far this week has been currency markets. So let's jump straight into it looking at dollar yen, because dollar yen has just pushed to fresh multi-decade highs today. It's in the upper 146s, and it's eyeing a test of this high that it printed. We talked about this earlier in the week, but a high that it printed all the way back in 1998, and that high is, let's get the exact high, 147.67. So, you know, it looks like we're kind of on a one-way streak in this direction. I mean, that's certainly been the case for all of the of 2022 so far, since March anyway. So I think it's just a question of when we test this level rather than if. You know, you've got US yields, which, just checking them right now, they're just at multi-decade or multi-year / multi-decade highs as well, with the 10-year just below 4%. The trajectory in US yields looks to be higher. You've got the Fed that continues to tighten aggressively. I can show you the economic calendar this week as well. Obviously, the key events that we have this week are coming up, like CPI tomorrow, then retail sales, then University of Michigan inflation expectations on Friday. But we've just had PPI, which was hotter than expected, 0.4% month over month. And I think it came in at 8.5% year over year. It's not saying here, which was a little bit higher than expected as well. So all signs in the data pointing towards an aggressive Fed still. You got the Fed minutes coming up, they're going to be hawkish. You got plenty of Fed speakers coming up as well for the rest of this week. They're all going to be hawkish. So, you know, the macro backdrop that sort of underlies this trend is very much going to continue. One of dollar strength, basically. Although, of course, with dollar yen, you do have this wild card of potential intervention from the Bank of Japan and the Japanese government to try and slow the pace of the yen's depreciation. So, you know, we had this big day of volatility back on the 22nd of September. That was a day when it was unveiled, basically, that the Japanese authorities had done a big intervention. So do expect some volatility. I mean, I'm still liking any dollar yen dips though, and were we to get anywhere near back to these sort of levels around 140, where we've got some support from the 50-day moving average there in red, and these recent highs and lows, you know, I would potentially be all over that, assuming that the fundamentals haven't changed and the Fed's still going to be aggressive and inflation's still hot in the US and all that kind of stuff. Another currency pair that's interesting, not so much interesting from a technical standpoint, because sterling kind of continues to just sort of languish around 110, but there has been quite a lot going on in UK markets this week, let's put it that way. UK bonds rallying, bond yields rallying, because yesterday, on Tuesday, you had the Bank of England Governor Bailey pretty much saying that they're going to end their support for bond markets at the end of this week, probably trying to instill a bit of a sense of urgency for the pension funds and those struggling with liquidity issues who hold large amounts of UK bonds to sort themselves out as quickly as possible. But, you know, sterling didn't like this idea of this support being withdrawn potentially prematurely, although that guidance from Bailey yesterday seems to not be credible, because then you had these reports come out in the Financial Times that actually the Bank of England had been telling some of these banks that they might extend that support. So everyone's kind of scratching their head at the moment and thinking, what's the Bank of England actually going to do? Like, surely they can't just pull this support at the risk of a financial crisis in the UK. But anyway, for now, sterling's around 110, and let me just show you some very ugly UK data. You had a bigger drop in, we had a surprise drop in UK GDP in August, minus 0.3% month over month, and you know, it hasn't come up on this calendar, but that was sort of driven by some much bigger than expected weakness in areas like manufacturing. So things not looking good for the UK economy. You've got a worsening global growth outlook. You've got the Eurozone, not the Eurozone, the European cost of living crisis, the European energy crisis. All these things seem to be driving UK economic weakness, which is not good for sterling. Even though the Bank of England is going to continue with its aggressive rate hikes because the inflation in the UK is still really, really high, and they need to do that to stop a real crisis of sterling weakness. They can't ease off the gas, otherwise sterling is going to get battered against all of its major peers. But like I say, that is only enough to stop a cascade lower, like we saw a couple of weeks ago. It's not enough to trigger a rally in sterling. So I think risks towards cable certainly still to the downside in the near term, especially given all that stuff I was just talking about when we were looking at dollar yen, with why I'm expecting dollar strength to continue. Quickly, let's have a look at the Dixie. You can see it's hovering here just below the multi-decade highs that it hit in September, and that is sort of reflective of where euro dollar is. Euro dollar continues to sort of languish within this trend line that I've been going on about for a very, very long time, and I sort of did call, I don't want to brag too much, but I did call the fact that this rally would be sold into last week, and it was. And I'm thinking at some point we're probably going to test these lows again. But moving on from currencies, let's look at stocks. Let's look at the S&P 500, or this is the CFD that I like to look at that tracks S&P 500 futures. Not much has been going on this week. We're kind of in wait and see mode ahead of these key events that we got later this week that I already mentioned: CPI, retail sales, University of Michigan, consumer sentiment and inflation expectations, and Fed minutes as well, and all the Fed speakers. So yeah, kind of in wait and see mode. But for me, you got to think that risks are still tilted to the downside. We're still in this technical downtrend. We've still got an aggressively hawkish Fed. I don't expect that any of the data or anything this week is going to change the narrative on the Fed front. And you've got increased worries about global growth happening at the same time. So it's almost like stock valuations being squeezed from the interest rate angle, and then also the earnings expectations angle. So I do expect this downtrend to continue basically. Are we going to get a break lower this week? We shall see. If we get a nasty surprise in any of this inflation data, then potentially. If not, then we might just kind of continue to languish. Of course, if we get a nice surprise with soft data that maybe points to the fact that last month's hot core CPI in the US was potentially a one-off, then we could get a bit of a relief rally. But I don't think anyone's really expecting that. Finally, let's look at oil. That rally above this sort of downtrend that we've been in for a couple of months did not seem to last very long, which is kind of what I was expecting. Remember earlier this week I was talking about how I expected the rally to peter out somewhere in the 90s, and look at that, we're back in the 80s again per barrel for WTI. And we do have OPEC with their big output cuts, but at the same time we've got global growth weakening. And I think one of the key things for oil this week is yesterday on Tuesday, or was it on Monday? Can't remember now, but anyway, that doesn't matter. This week we had the World Bank and the IMF come out with very gloomy outlooks for global growth, pretty much because of all the tightening and the cost of living crisis and the ongoing restrictions in China, the war in Ukraine, and all of these reasons that are just hurting global growth from various different angles. And that this all hurts demand for oil. So yeah, the macro story I think is going to continue to weigh on oil, and I think we're probably going to continue to move lower. But guys, yeah, I think that's pretty much it. Pretty much all the main points covered for this video. Hope you enjoyed it, and I will see you all in the next one.